In the fast-paced world of investing, the stock market has long been a symbol of strength and prosperity. But what happens when that strength falters? In 2025, we stand at a crossroads, facing a series of risks that could change the global economy forever. The United States stock market, the backbone of world finance, could be on the brink of collapse. How did we get here? And what could a market collapse mean for your future? The United States stock market is not just an American phenomenon, it is the heart of global finance. From Wall Street to Silicon Valley, it influences everything from global trade to personal retirement accounts. But beneath the surface of impressive gains and record highs, something is stirring, a perfect storm of economic forces that could shake the market to its core.
The stock market has been in a nearly uninterrupted bull run for over a decade. We're living in an era of unprecedented growth, but that's exactly what concerns me. Every market goes through cycles of expansion and contraction, and it's looking increasingly like the contraction part is coming soon.
While the stock market has delivered strong returns for years, it's been a volatile journey. And experts now say we're overdue for a correction, maybe even something worse. In 2025, there are growing concerns that the conditions are ripe for a significant crash. There are many factors at play, from inflation to interest rates, global trade tensions to corporate debt. The elements of risk are converging in a way that we haven't seen in years. For the average investor, the question is no longer if a collapse will happen, but when. Inflation remains stubbornly high, a trend that has persisted longer than anyone anticipated. The Federal Reserve's response has been a series of interest rate hikes, with rates at levels not seen since the early 2000s. But these measures, while necessary to tame inflation, are creating their own set of challenges.
Higher interest rates are a double-edged sword. While they may reduce inflation, they also make borrowing more expensive for both individuals and companies. This slows economic activity, and when that happens, corporate earnings fall, which directly affects stock prices.
Interest rate hikes affect everything from mortgage payments to car loans. In addition to making borrowing more expensive, they're also cooling down consumer spending, which is a significant driver of the U.S. economy. Consumers, who have been essential to keeping growth afloat in the post-pandemic era, are now feeling the squeeze.
The American consumer has been the backbone of economic growth for decades. But as inflation eats into wages and credit becomes more expensive, we're seeing people cut back. That means fewer people are buying homes, fewer people are upgrading their cars, and fewer businesses are expanding. This slowing down could be the trigger for a broader market downturn.
The global economy is also feeling the pressure. Trade tensions between the U.S. and China, as well as other economic disputes, have raised costs for businesses and consumers alike. Supply chains remain disrupted, and geopolitical instability has further complicated the economic landscape. This creates a volatile environment for stock market investors who are already grappling with rising costs at home.
Global trade has become a battlefield. Tariffs and sanctions have forced companies to rethink supply chains, leading to higher production costs. When you combine that with the uncertainty of geopolitical risks, such as the war in Ukraine or tensions in the Middle East, it only increases the risk of a market collapse.
The echoes of the 2008 financial crisis still reverberate today. The global economic system nearly crumbled under the weight of high-risk mortgage lending, financial derivatives, and a complete lack of oversight. Many believe that the events of 2008 could be a warning sign of what's to come. While the causes are different today, there are striking similarities in the levels of risk building within the market.
The 2008 crisis was sparked by unsustainable debt and reckless financial products. Today, we're facing a different kind of risk. Corporate debt is at an all-time high, stock buybacks have reached record levels, and there's a sense of complacency in the markets. People have forgotten what happened last time.
The corporate debt issue is crucial. Since the 2008 crisis, companies have increasingly relied on cheap debt to fund growth, often through stock buybacks to prop up their stock prices. But now, with interest rates climbing, those debts are becoming more expensive. Many large corporations could soon face serious difficulties in servicing those debts.
Corporate America has been living on borrowed time. A lot of businesses are sitting on massive debt loads, much of which is tied to variable interest rates. If the economy slows further, these companies will be forced to make tough decisions, layoffs, reduced investment, and potentially even bankruptcies.
The warning signs are already here. In recent years, we've seen sharp corrections in the market, massive drops in stock prices with little to no explanation. While these drops have often been followed by quick recoveries, experts warn that we could be on the brink of a major sustained downturn.
What we're seeing now is a market that's moving more erratically. There's a lot of speculation, a lot of short-term thinking, and not enough focus on long-term fundamentals. The market is starting to feel like a bubble, and we know what happens when bubbles burst.
The S&P 500 has been a consistent measure of U.S. economic health. But as the index reaches new heights, there are growing concerns about overvaluation. Is the market overpriced, or is it reflecting true economic strength? The answer to that question could determine whether we face a correction or a full-blown collapse.
When valuations get stretched, there's a risk that investors are betting on a future that doesn't materialize. If corporate earnings don't live up to expectations, the entire market could fall, causing a cascading effect on stocks across the board.
The implications of a market collapse would be far-reaching. It's not just Wall Street that would suffer. Millions of Americans who rely on their 401(k)s, pensions, and investments would see their savings wiped out. Those approaching retirement would face the devastating reality of having to delay their plans or adjust to a drastically different lifestyle.
I'm close to retiring and my nest egg is tied up in the stock market. I can't afford another 2008. It's not just my money, it's my future.
A market collapse would crush small businesses like mine. We're already operating on thin margins, and if consumer confidence drops, we'll be the first to feel it. It's a tough time to be an entrepreneur.
The future is uncertain, and while the risk of a collapse in 2025 is real, the question remains, how will we respond? History shows that no market downturn lasts forever. The resilience of the American people, the innovation of businesses, and the recovery of the economy are all factors that can ultimately bring the market back from the brink. For now, we wait and watch, hoping that the lessons of the past will guide us through what could be an uncertain future. Will 2025 be remembered as the year the stock market collapsed, or will it mark the beginning of a new era of recovery and growth? Only time will tell. Subscribe for more insights into the future of the economy.